Stewart Glickman is here, energy equity analyst at CFRA Research. It's great to see you. I thought this was really interesting news. This was reported by The Guardian that this Iranian supertanker was possibly delivering oil, right, to Syria off the coast of Gibraltar, and it was stopped by these British troops.
Yes.
This is big news, right?
It's like out of a movie or something.
I mean, like, my kids don't care about this, but we should care about this. Why?
We should care about this because if Iranian crude oil, which the U.S. obviously is trying very hard to try to reduce Iranian oil exports from, what had been 2.5 million barrels a day down to zero. It's moving very far in that direction, but it's not quite at zero yet. To the degree that the U.S. or its allies can cut into Iranian oil exports, that takes a fair amount of supply off the market. That should raise the geopolitical risk premium and push oil prices higher.
And then oil moves higher. I understand. Just this last week, first of all, I saw the weekly data on Wednesday that came out, the government data for the third week in a row. We saw declines in stockpiles. So it was 3 out of 5 weeks that had the decline. So we've seen some back and forth. But earlier in the week, we saw OPEC extending the cuts. Great, ho, ho, rah, the oil moves higher. And then quickly after, concerns about demand for oil. And then oil moves lower.
Yeah.
What's going on?
So OPEC is right to be concerned because there are worries that particularly emerging markets are going to slow down. And so what OPEC is saying is we're going to extend the cuts. Normally it would be a 6-month period that they have in the past done extensions for. Now they're saying we're going to extend 9 months, which I think is sort of tacit recognition that the worries about demand are not going away. Yeah. So they had a 1-day pop in oil prices on the news of the 9-month extension, and then the next day there were concerns about China slowing down, concerns about the global economy, and global GDP is highly correlated with oil demand. Right. So if the global economy and particularly Asian markets start to slow down, that's really bad for crude demand.
Right. Why do you have a strong buy on Conocophillips?
So Conoco is an E&P, meaning all they do is upstream production. But for the last several years, they were among the first, I would say, to begin to focus on living within their means and going after higher margin barrels. And the amount of free cash flow that they throw off from their production is best of class, I would say, among the E&P community. And we have a strong buy recommendation, as you said, 5 stars. Our 12-month target price for them is $82.
It's sitting at 60 right now.
It is sitting at 60, so that's a healthy amount of upside that we think that they can achieve. And I think that most of their barrels are tied to or priced around Brent, which is a higher value than WTI.
Yeah.
I think it's simply a matter of time for them that the market hasn't fully realized the kind of value that they're going to throw off and the earnings power they have.
So that goes into oil services, you said? Is that what
No. So that's
production.
Exactly, E&Ps.
And then what about Exxon? That one you didn't like as much, right?
No, we have a 4 stars or a buy opinion on Chevron.
Right.
By contrast, the other behemoth in the industry, ExxonMobil, we have a hold or a 3 stars opinion on.
Okay.
So between the two, usually you compare Chevron against Exxon.
Yeah.
They're both integrated. They have the upstream as well as the downstream operations. Chevron is doing a better job, in my opinion, excuse me, at production growth. They're doing a better job on their margins. The downstream side, they're generating better cash flow from their barrels than Exxon is. So across the board, I think Chevron's a better play right now.
Chevron's the better play. It's up 13% this year. But when we talk about this, so what areas of energy do you stay away from? I mean, if you're an investor, is there something to stay away from, really? Or we just look at these big guys and that's the way to go?
So, no, I would say, broadly speaking, you have kind of 6 areas in energy. The 2 areas that I would say are the most concerning to me are related to oil services. So either the oil services companies like a Halliburton, for example, or the offshore drillers like a Transocean. Both of those names depend on E&Ps spending money, opening up their pocketbooks and saying they're going to sign more rigs, they're going to spend more money to get the oil and gas out of the ground. But that value proposition has gotten so far in favor of the buyers that a lot of these E&Ps, Conoco, EOG Resources, Devon Energy, they are all able to generate more production with less spending.
Right.
It's a great deal if you're the buyer.
So the EMPs run the show.
Yeah,
is basically what's happening here.
They very much do.
I mean, it's so different because I remember 15, 20 years ago, I mean, we went right to Halliburton and Schlumberger and looked at those names to really get a gauge of what's going on, but that's not the case anymore. When we talk about OPEC, it's interesting because I've talked to people who actually own oil refineries, and this particular gentleman, John Katzmatidis, he was saying a fair price to keep Saudi Arabia happy is probably around $75 a barrel.
Okay.
We're lower than that.
Yeah.
I mean, I don't know. Where do you think oil really should be? Is there a level that it should be, or where? I don't know.
I think so. There's a contrast between where I think it should be and where the Saudis would be happy with it.
Oh, they'd love 100, right?
I think a fair price right now is somewhere around $70 a barrel.
Yeah. Okay,
I
so
think,
you're near him.
I think that what the Saudis would be looking for is more like 85. You don't want to push it too high, because if you do, then you run the risk of just killing off demand, because prices get so high that people just stop using it.
Then you have the dollar. I mean, the dollar is a big part of this, right? Mm-hmm. So as the dollar goes up or down, I mean, how does that affect the investment play? So the next few months, what should we watch in the move in the dollar and say, oh, what about my oil investment?
So typically, and it doesn't always work this way, but typically, oil prices and the dollar are inversely correlated. So if dollar is going down, oil prices should go up. So to the degree that the dollar is strengthening, that's typically bad for oil.
Right. Right. And what do you think about just the landscape going into 2020? Mm-hmm. We have, so many elements. We have tweets, we have China, we have Fed, we have, what's going on with the consumer and global slowdown, but we got jobs. I mean, what's the big picture for the next 12 months?
So I think the big picture takeaway is you should have reasons to be worried about global demand. And in that kind of world, if you're worried that demand is not going to be accelerating, it might be decelerating growth or perhaps, flatlining. The best space, I would argue, in energy is the midstream space. These are the pipeline guys, the ones that are simply moving the crude oil or the natural gas from A to B, because they depend more on the volume than they do on the price of what it is they're moving.
All right.
So if oil's $40 or, actually, I shouldn't say that. If oil's $50 or oil's $70, it doesn't quite matter as much. Enterprise Products Partners, EPD, is a good name there.
Stewart Glickman, CFRA Research. Thanks for watching The Watch List. See you Monday.